Money makes the world go round, so the song goes. And it's true. You do need currency to trade and travel and transact with people in other countries. And when I say currency, I mean the traditional kind. Your yen and your euro and your peso. We're not doing cryptocurrency today. That's a whole other episode. Instead, we're focusing on the traditional stuff. And in particular, the US dollar. Because, whether you like it or not, the greenback is the king of the currencies. Its value affects you whether you live in the US or not, and it's been doing very well recently. So what does that mean for you and for the wider economy? Let's find out. It's what we do here on Reuters Econ World. Every week we pick a phrase or buzzword and go deep into the economic principles and ideas driving the biggest news around the world. This week, currency. I'm your host, Carmel Crimmins in Dublin. Money has evolved a lot since the days when we used cows to pay for stuff. Nowadays, we use currencies. And in particular, the US dollar. It's the closest thing we have to a world currency. It's the most widely used for international trade. And central banks prefer to hold dollars in reserve over any other currency, despite efforts by some countries to diversify away from it. It's been this way since the US's emergence as a global superpower after World War II. Investors trust the dollar as a place to stash wealth. But that means that the world's economic fortunes are tied to the dollar. And recently, it's been on a tear. This year alone, it's up 10% against the yen and 6% against the Swiss franc. And it's risen around 15% over the past 3 years against a basket of major currencies. So what does that mean for consumers inside and outside the US? We've got two people here today who are experts when it comes to the dollar and the FX market. Howard Schneider, who, if you listen to our weekday news show, is our go-to guy on the Fed and the US economy generally. Howard, thank you so much for joining us. Where are you talking to us from today?
We're down in South Carolina, our family place down here. So looking at the pecan trees, the dogwoods have lost their flowers, but still quite nice.
Oh, lovely. We also have Karin Strohecker, our emerging markets chief correspondent in Canary Wharf. Karin, welcome. Do you actually see any wildlife, any trees, any livestock in Canary Wharf, seeing as Howard is down on the farm?
Only concrete jungle and suited life forms here.
I am sorry. Sorry to hear that. We're talking currencies and in particular the strong dollar today. Howard, why is the dollar so strong at the moment?
Well, a couple of things. One is that the Fed has set its interest rate very high. And if you can get a good return on what's considered the anchor risk-free currency around the world, the US dollar, you take that, right? So that attracts money in for strong reasons, right? Because you get a good return on that. Also, the US economy is holding up quite well. So no risk there. A counterfactual would be the flight to safety. We see sometimes if there's trouble around the world, if the global economy is collapsing, something like that, people rush to the US dollar to take what they can get and know that they're going to wake up the next day and the dollar will be roughly worth $1, right? That's kind of dollar appreciation for negative reasons. This is kind of firing on all cylinders, a real return in excess of inflation, high interest rates that we haven't seen in a long time.
Right.
And a US economy that's doing well and a global economy that's kind of standing up on its own.
Strong dollar, it sounds good. Is it good? Like, who wins from this in the US?
Yeah, well, as with any economic issue, there are benefits and costs, and they get apportioned across different groups of people. In the case of, say, a strong dollar, at the margin, imports become cheaper, right?
Mm-hmm.
If your dollar buys more euros, your dollar will buy more French wine and more British beer and more German automobiles, okay? So that's good if you're a consumer open to buy an imported product. If you're a US exporter, well, the opposite's true, right? The people in your export markets are going to be paying more dearly in dollar terms for your commodities. So it's difficult on US manufacturers and exporters. Look, if you're in a fixed income market, if you've got attempted to just squirrel money away into US Treasury bonds, now's a great time to do it, right? Because the interest rate's as high as it's been in probably 20 years or something like that. So they're winners there on the fixed income side. And that reverberates really around the world. Again, regardless of all the talk about dollar losing its strength and the US losing its luster, this is the anchor currency in global financial markets. So anybody that's holding on to a dollar right now is doing better than anybody that's holding on to something else.
The losers from all this tend to be countries who have borrowed in dollars, who are very exposed to the US dollar. And that's particularly the case for the world that you look at, which is emerging markets, right?
That's right. So one part of the puzzle is, of course, if you have gone out as an emerging markets economy and you have borrowed money on international capital markets, it would have been most likely in US dollars. Now you need to pay that back and you need to pay interest on it and you need to pay the whole bond back. And now that's going to be a lot more expensive for you than it was before. And for the bigger emerging markets like the South Africas, the Brazils, and so on, we have seen efforts of switching possibly more borrowing to domestic markets so they don't expose themselves quite as much to that strong currency in the future.
Right.
A lot of the small economies, they don't really have that luxury. They go either to global capital markets or not, and they have to foot the bill for that. And that's where we've seen the debt distress coming out in recent defaults, for example.
It wasn't meant to be like this year, Howard, right? Like people were originally expecting a dollar sell-off had the Fed actually cut rates, which was what people had been predicting towards the end of last year.
Sure, the expectations have definitely shifted over the last few months with sticky inflation in the US. And it's put all the central banks of the world, the ECB, BOE, Bank of Canada, everybody sort of, well, when's this going to happen? Because to the extent the Fed stays higher for longer, even though every central bank is managing for their local conditions and can manage for their local conditions, it does change the way they think about things and perhaps the timing of some of their own actions.
Howard's right. It is exasperating for other countries, isn't it, Karin? Like it is hard for other central banks. And right now, the strong dollar is being particularly felt in Asia.
Yes, definitely in Asia. So if we look at the global landscape of central banking, actually in this cycle, both in the hiking cycle that we have seen when inflation came up and now in the cutting cycle, emerging market central banks have been front-running the Fed. Now that's quite unusual. In the not too distant past, actually, they usually would wait for the Fed to give their cues before they moved. But now they have been very proactive. Like, for example, Brazil in Latin America was at the forefront of that, emerging Europe as well, and now on the way down as well. But Asia wasn't quite there. And now they are feeling the pain of those higher for longer rates and their currencies being under pressure.
Sticking with Asia, it's a good place to find a group of people who are benefiting hugely from a stronger dollar. The US tourist abroad. Sakura Murakami went to find some for us in Tokyo.
I'm standing outside Sensoji, the oldest temple in Tokyo, which has a history that goes back some 1,400 years. Back then, this area, called Asakusa, was a small fishing village, but now it has flourished into a popular attraction for visitors to Tokyo. This particular temple usually draws about 30 million visitors a year. That number could increase, as Japan is set for a potential record year for tourism. The two main drivers is pent-up demand after the pandemic, as well as a historically weak yen. Travelers are seeing their money go further and have spent a record 1.75 trillion yen, that's $11.2 billion, in the first 3 months of 2024, according to Japan's tourist agency.
So we landed yesterday.
Okay.
So yesterday and today we're going to be in Tokyo.
I talked to some tourists traveling from the US to understand how the weak yen has influenced how they spend their money in Japan.
We've been shocked at how cheap it is to eat here compared to in the US.
Right. And how is that? Like, I haven't traveled to the US in a really long time, actually, so I only know Japan
Very
prices
expensive.
compared to here.
Oh,
like,
yes.
for example.
A food. So, like for my daughter and I, before I came on this trip, we went out for tacos. We each had 2 tacos, rice, chips and salsa, and 1 drink, and it was $55 in US dollars.
Okay.
And it didn't play into our decision to come, but we found out after the fact, and it was just shockingly cheap.
And the quality of the food is much better for the price. So for $55, all 4 of us can eat here and have a beer with it. and you get a lot of food. Whereas in the U.S., you get 2 small tacos with some rice and chips for $55.
And that doesn't even include alcohol
No,
or drinks.
no.
Right. Are you finding that you're kind of spending more or like doing more because you found that the yen is weaker and that you can
It's easier to let go of money.
It's
when
easier
it's
to-
when it's cheap. I mean, it's like, sure, I'll buy that.
It's easy to buy custom flip-flops.
yeah, sure, yeah. Oh, is that what you got?
Yes.
Oh my God, and it's so nicely packaged.
It is.
as
His
well.
wife made the origami.
Oh, that's so sweet. Is that for yourself or is that for
It's for me.
Yeah,
Of course.
You need to treat yourself as well. Yeah. Do you feel like you're doing things that you usually wouldn't do on a regular trip to Japan, like because
for
of
sure.
the weekend?
I think so, yeah. I mean, because typically, if I was to do this trip before, we probably would just stayed one night in a hotel and flew out the very next morning. But because of, unfortunately for Japan, the inflation and the currency is weak, U.S. dollar is really strong, we decided to extend our layover and do things that we probably typically wouldn't have done in a normal economy.
Yeah, definitely. Well, I mean, I guess it's good for the
local
businesses
economy.
here.
Yeah, sure.
And thank you for spending your money here.
Of course, yeah, a pleasure. It's a pleasure.
Okay, well, thank you so much.
I have to ask, Howard, where are you going on vacation?
I mean, I have, by the circumstances of love and romance, ended up with a whole bunch of cousins-in-law in central France. So we're going over there for about 10 days.
Ooh, nice. Karin, what about you? Where are you heading this summer on your holidays?
So this summer, I'm going to Sri Lanka, actually, which is a country that is just coming out of a debt crisis that might have had its debt restructuring by the time I arrive there. I very much plan on going, looking at the jungle and looking at elephants and looking at beaches and not write about a debt restructuring. So that's my hope. But yeah, it's a country that is looking forward to having more tourists come over. It's a big industry and revenue spinner for Sri Lanka. So I'll put my British pounds to use over there.
Yeah, and that is perhaps some comfort for countries like Turkey, like India, like Sri Lanka. They are getting more US visitors and US tourist dollars. So every cloud.
Exactly.
Although neither of you are going to get many clouds in central France or Sri Lanka. Howard, in the past, we have had America working with its trading partners to weaken the dollar.
Mm-hmm.
The Plaza Accord back in 1985, with an agreement between the US, the UK, France, Germany and Japan to devalue the dollar and help reduce the US trade deficit. Would anything like that happen now?
Yeah, I don't see that happening through a currency channel. If you're going to start talking about ways to tilt the US trade deficit, it's going to be through tariffs or going to be through trade restrictions or something like that. Biden and Trump are both doing it. They did it for different reasons. They will do it across a different set of goods, perhaps. But I can't see any sort of grand bargain about foreign exchange in this sort of current situation.
Karin, my understanding is that in recent years, a lot of emerging markets have reduced their borrowings in US dollars. They've built up their foreign currency reserves, which are like their ammunition to protect themselves. And their monetary policy, not in all cases, but in some cases, has become more rigorous. So they've raised interest rates earlier and higher so that they're in a better position for a stronger dollar. But they're still exposed to foreign investors who can drop them fast if things start getting difficult, right?
Yes, for sure. And that is something that these emerging economies are acutely aware of. And I guess the other part of the puzzle for the strong dollar is just like Howard said, if you want to, the exporters in the US have issues. Those countries who very heavily rely on imports, whether that's crude oil, food, pharmaceuticals,
right,
whatever it is that you need to bring in and pay in dollars, those have really felt the pain of the strong dollar. So, for example, one big one of those is Turkey, right? And we were looking at this for stories earlier. If you look at, for example, crude oil prices and you look at them in US dollars, which is what they're widely priced in, Brent crude has gone up around about 9% since the start of the year. If you look at that increase in Turkish lira, it would have been a 76% increase.
Whoa.
So that is massively inflationary. Quite often, of course, these governments will have to then step in and maybe come up with fuel subsidies or support of sorts. But again, that is costing them money. They need to use precious foreign currency reserves to help them mitigate the situation. And that's a balance they have to strike very carefully.
It is an expensive business, right? Intervening to defend your currency. Like Japan has been shelling out a lot to bolster the yen, right, Karin?
Yes, it has. And we were watching that like hawks here every time. And as we see currency markets maybe go down, moving like they have done a couple of weeks ago, the question is how much bang for your buck, if you excuse my language, did you actually get out of that? And we've heard some rumors about other central banks also possibly intervening more heavily, especially in Asia again. So we might see more of that, depending how long the dollar strength lasts and what the dynamics around it are.
Back in the day, years ago, decades ago, even if I can go back that far, you'd hear more about the role of exchange rates in all of this. But exchange rates have become more flexible, right, Karin?
Yes, they have. By and large, there's very few countries now who have fixed exchange rates. Also, because if you fix an exchange rate, you need to regulate it to keep it at a certain level. Either you need to restrict outflows, which means capital controls, and people won't come and buy your stocks or bonds because they're not sure whether they will be able to get their money out. Or you need to artificially buy your currency, which means selling US dollars or selling euros to prop up your own currency to keep at that level as soon as there are economic pressures. And both of those are very costly and normally not very good long-term strategies.
Yeah. Fundamentally, what we're seeing here is interest rate differentials which are driving this. And so how do we get out of this position? It's through the Fed cutting rates. Or is that too simplistic, Howard?
Well, I think it may be the Fed cutting rates, but they're not going to cut rates until U.S. inflation comes down, right? So that's kind of behind it all. Is it too simplistic to say it's just the rate differential? If inflation comes down, that's going to imply slower U.S. growth, which allows the rate cut to go on. And to that extent, it may sort of cool the whole global climate down a little bit.
Yeah.
So, yeah, you may benefit from change in the Forex and dollar dynamics there, but at a cost.
And the longer this goes on, Karin, how difficult does it become for those emerging markets, even the ones who have built up their resources, their reserves, who are sort of trying to defend themselves as best they can? The longer this goes on, what does that mean?
Well, there are two aspects to this. So one of them is the central bank rates in the emerging markets and that they need to keep a differential with the Fed and they can't get too close to Fed rates. But what that means, if you hold your interest rates high, you are in danger of dousing growth, of course, in your own economy, right?
Yeah.
It's not very good. So you need to have that very fine balance, like keep the interest rate differential, but not kill off your own growth in your country.
Just to explain to our listeners, they need that premium so that people will buy their debt, right?
Exactly.
Because if you're in the market and if it's a choice between US debt and debt from a country that maybe is politically uncertain, has high debt levels, a lot of uncertainty, you'll go for the dollar, right? Unless you can earn a premium.
Yes.
To compensate you for that riskier debt.
So exactly. So the more risk you take, the higher your premium needs to be. So you need to be getting a higher reward for putting your money into South Africa or Brazil over the United States of America. And of course, that also is reflected then in the interest rates, that is by the central banks. And those have to be higher than the US central bank rates in general. Then the higher for longer the US rates stay, that sort of limits the room for maneuver that those emerging market central banks have on the way down. So there's quite a few countries who are waiting for those US rates to go down. And the sooner they go down, the better it will be for them. There's a second problem then, that especially for those countries who are forced to borrow or who would like to borrow on global capital markets, who would like to raise money, sell bonds there.
Yeah.
Their pricing, how much they have to pay, depends very much on a premium that they pay above US rates. So the higher the US base rate is, the higher the total will be that they have to pay.
Okay.
And that makes debt just much more unaffordable for some of them.
Thank you both so much for taking part in the discussion. It was great having you on today.
Sure thing.
Thanks, Carmel. Thanks, Howard. Bye.
And thank you for listening too. We hope you're enjoying the show as much as we are. Every week, we try to tease out one economic principle behind the news. We give a sprinkling of history, we talk to experts, and we try to humanize it all with a real-world example. If you like what you hear, we'd love it if you shared this episode with a friend. There's a newsletter to accompany the show. You can subscribe to it on Reuters.com. Till next week, a big thank you to Howard Schneider, Karin Strohecker, Sakura Murakami, Amanda Cooper, and everyone who covers markets and economics at Reuters. Jonah Green is the producer of this week's show. Sound design was by Josh Summer. Lila de Kretzer is our executive producer. Our podcast team includes Kim Vinnell, Tara Oakes, Christopher Walljasper, David Spencer, and Gail Issa. I'm your host, Carmel Crimmins. For all your daily news, check out Reuters World News, our weekday 10-minute podcast.